Hi, everybody, and welcome back to the channel. I'm Danny Yale. I'm a loan officer with People's Mortgage. And today I'm going to go over some quick and dirty math to explain how you can buy a property that's between 2 and 4 units and house hack, where you live in one of the units and then have the other units producing income for you. Um, and I'm going to explain some of the advantages of doing this and then talk about one major disadvantage, but then show you how you can turn it into a positive. So, like I said, we're going to be going over some math. I'm going to show y'all an amortization schedule, and this is for a purchase of $300,000 using an FHA loan where you put down 3.5%. And that allows you to buy. You could buy a single family home, or you could buy a duplex, a triplex, or at maximum, you can buy a 4 unit, also known as a quadplex, with just 3.5% down. So that's a major advantage. Like I said, if you buy a 4 unit property, you can live in one of the units and collect rent from the other three. Hopefully, that will cover your entire mortgage payment, and therefore you can live without having to go into your own pocket to put a roof over your head. If that's not the case, then in a year or 2 years or 10 years, when you move out of that property, it's very likely that you will have a positive cash flow when you can rent out all 4 units. So, one of the things I want to show y'all is that it's kind of expensive to use an FHA loan because of this right here, the monthly mortgage insurance. So in this amortization schedule, you'll see we start out, we've got a principal payment of $235 and then an interest payment of about $1,750. That gives you your principal and interest at $2,188. But then you've also got this pesky mortgage insurance of $204 a month. So that mortgage insurance is going to be on the life of this loan, meaning you pay mortgage insurance as long as you have an FHA loan on this property. Most people would say, no, thank you. I don't want to do that. And it's hard to blame them. However, if you think about what you're truly getting, you're getting a property that's either income producing from the start or will soon to be income producing. And you get to live either for free or at a discount in that property. So if you think about it that way, this $200 a month really is not that major. But over the course of 30 years, if you can avoid paying $200 a month, I would suggest it. And so what I'm going to show you with the quick and dirty math is there is a way to remove this $200 a month payment after you've owned the property for some time and you've seen it appreciate, all the while you're paying down the loan that's outstanding. So if y'all aren't familiar, an amortization schedule is going to show you from payment number 1 all the way down to payment number 360, or 30 years worth of your mortgage. And let me scroll back towards the top. You see the monthly payment remains the same for all 30 years. All 360 payments are equal at this principal and interest at $2,188. What changes each month is the amount of principal you're paying down and the amount of interest you're being charged. And so it's very slight in the beginning. You see 235.56. Then it goes to 236.96. So each month you're reducing your loan by about $236. But it goes up by $2 each month. And your interest therefore gets reduced by $2 each month. So that's pretty slow going. A 30-year loan, you're in for a long commitment. But over time, you see about 3 years in, each month you've built your way up to paying off about $290 worth of principal, and you're paying less than $1,700 a month in interest. And so, buying a house, it's a big deal. It's an expensive thing to do. Borrowing the money, as you can see, the interest cost is also quite expensive. So what I really wanted to show y'all is that we can get this loan paid off in 30 years. Naturally that's the point, but the point of this video is to show you that if you buy this income producing property using an FHA loan with 3.5% as a down payment, and you get stuck with a $200 a month mortgage insurance payment, that's not helping to reduce your principal. It's just an added cost. It's essentially additional interest because it's just part of financing a property. But if you're able to buy a property that will appreciate over time, which most will, then you can see some good success. Sorry, I had to get those ads out of here. So want to talk a little bit about property appreciation. In the past 2 years, we've seen properties appreciate at astronomical levels in the 15 to 20% annual range, which is awesome if you've owned property at that time. But something a little bit more normal, something that's sustainable, is an appreciation rate of about 4%. So that's what I'm using here in this example. So we're showing a starting value, like I said, a $300,000 purchase, growing at 4% each year. And we are looking to get to this desired final value of $368,000. Now, that's just an important number for this math equation. It doesn't mean that that's the ultimate you want this property to grow. Obviously, you want it to become more and more valuable each year so that ultimately you can sell it and you'll have created wealth over time. But the reason this $368,000 number is magical is because we're trying to get the mortgage insurance dropped from this property. And the way that you do that is by refinancing out of the FHA loan into a conventional loan. So I've got the guidelines pulled up for Fannie Mae. If you are going to do a refinance of 2 to 4 units, you've got to have a loan to value of 75% or less. So, I'm sorry, and this is for a principal residence. let's look down here. We can either look at a limited cash out refinance, or we can look at a cash out refinance. For the purposes of this, we're going to look at a limited cash out refinance. And the loan to value still just needs to be 75%. And what that means is you've got 25% equity in the property, which would leave you with a 75% loan compared to the value of the property. And when you reach that point, you're then eligible to refinance into a conventional loan. Now, conventional loans don't have mortgage insurance when you have more than 20% in equity in the property. So in this instance, we'd have 25% equity in the property, and therefore it's a ripe opportunity to refinance and drop this $200 a month payment. And so I'm going to go back to this tab and show you this calculator. While it's not very pretty and has a bunch of ads, it does help in determining how long you have to own this property in order to reach a 75% loan to value. So, excuse me. Let me pull up this calculator, and I'm going to go to 62 months on our amortization schedule. So at 62 months, we'll have paid the principal down to about $277,000. And we know after 62 months at a 4% appreciation rate, this property is going to be worth $368,000. So back to this calculator, we're going to look at 277 divided by 368,000. So the 277 is what we owe, and the 368 is what the property will be worth, we think. And that gets us pretty darn close to a 75% loan to value. So at that point, give or take maybe a couple $1,000s, you're going to be able to refinance out of this FHA loan and therefore begin to save an additional roughly $191 each month. So in the grand scheme of things, let's say we've got a $360 month loan. We were in it for 62 months, meaning we've got 298 months left on this loan. So 298 times $190 a month. Well, forgive me, it's actually not $190 a month times the remainder of the months that you have, because as you can see, this amount decreases with each month or with each year. However, you do save a considerable amount of money by taking this approach and refinancing out of that FHA loan as quick as the market allows you to. And so that is really the point of this video. I had some clients who were looking at buying a multifamily property, and I brought up a little bit of a complex subject, which is refinancing. And they wanted to see the math, how it works. And, I'm a visual person myself, so this video is really helpful, I believe, to illustrate what a refinance can do and why you would want to consider doing it as quickly as possible to get out of an FHA loan. So um, let me know what questions y'all have. I'd be happy to go over this in more detail. If you're in El Paso, we can have a meeting in my office. If you're not in El Paso, technology is great. We can hop on a Zoom call and hammer this out. So thank you guys for joining. If you've got any more suggestions for new videos you'd like to see, let me know. I'm a bit of a numbers guy. I will go through mortgage numbers all day long with people. So if that's what you want to see more of, please just give me a shout. All right. Thank you.